14 of 21 series are aligned with a stagflation mild configuration this morning. That is a moderate level of systematic agreement across the framework. The current macro regime is stagflation mild, with a confirmation score of 14 out of 21. In our framework, a stagflation mild macro regime means growth momentum is mathematically decelerating at a rate of change reading of roughly minus 0.16, while inflation momentum is mathematically accelerating at about plus 0.01. The coherence score is in a moderate band, and the confirmation score of 14 out of 21 series indicates that 2/3 of the tracked indicators are pointing toward the same stagflationary configuration. By our framework's reckoning, regimes with confirmation scores in this range have historically persisted in roughly 41% of comparable cases over rolling 3-month windows, with the most common subsequent regime being an acceleration-style state. Compared to last week, growth momentum has softened slightly, and inflation momentum has edged higher, while confirmation has remained in that mid-teens range rather than breaking higher or collapsing. Historically, environments like this have felt grindy across markets. Broad equity indexes often moved sideways with higher dispersion beneath the surface. Defensive sectors and real assets held their ground more often than not, and real returns were pressured by the interaction of moderate growth and persistent inflation. A record of past behavior, not a roadmap. Let's walk through 4 signals the engine is watching inside those 21 series. First, Treasury yields. The 10-year Treasury yield is around 4.57%, the 2-year sits near 4.16%, and the curve is modestly positive with the 10-year minus 2-year spread near 0.37 percentage points. The engine flags the longer end of the curve as green momentum because the yield is holding above 4.5% with a mild positive rate of change over recent observations, defined in our math as an upward move of a few tenths of a percentage point sustained across multiple sessions. Markets watch this because the 10-year influences mortgage rates, corporate borrowing costs, and the discount rate applied to future cash flows. The question it raises for risk takers is simple. Does a higher, gently steepening curve change how much duration or equity exposure they are comfortable carrying? In our framework's reading of comparable periods, this roughly coincided with inflation composites showing accelerating behavior within subsequent observation windows, an observation under our methodology, not a forecast. What would challenge this read is a decisive reversal lower in long yields or a reflattening of the curve that compresses the spread back towards zero. Second, labor conditions via non-farm payrolls. Recent data have pointed to payroll growth losing momentum compared with earlier in the year, which the engine maps as yellow labor momentum, neither sharply negative nor strongly positive, but with a clear deceleration in the monthly change once smoothed through the framework's filters. Markets watch hiring because it anchors household income, consumption, and default risk. The question it raises is whether a softer but still positive labor market alters how participants think about recession risk and pricing across cyclical sectors. In our framework's reading of comparable periods, this roughly coincided with equity markets showing more defensive leadership and a tilt toward companies with stable cash flows over the following sets of observations. A record of past behavior, not a forecast. What would challenge this interpretation would be a re-acceleration in hiring or a drop in unemployment claims that pushed labor momentum back into a clear green band. Third, credit conditions, with a focus on corporate bond spreads between high-yield issuers and treasuries, a plain measure of perceived default and liquidity risk. Recently, spreads have been contained, with only mild widening despite the macro backdrop, so the engine classifies credit momentum as yellow, a stable configuration where spreads are neither compressing aggressively nor flashing stress. Markets watch this because it speaks to funding costs for riskier borrowers and the appetite for bearing credit risk. The question is whether contained spreads align with the macro data or market tension between economic softness and supportive markets. In our framework's reading of comparable periods, this roughly coincided with episodes where equity volatility stayed range-bound and sharp dislocations were less common over subsequent weeks. An observation under our methodology, not a forecast. A clear challenge to this read would be a decisive, sustained widening in spreads, pushing momentum into red and signaling a different credit environment. Fourth, sector behavior, focusing on technology, energy, and gold. Technology and financial stocks have been under mild pressure, energy has firmed, and gold and long bonds have held their ground. The framework codes technology and cyclicals as red or soft rate of change, energy as green, and gold as green, based on whether each has been rising or falling across recent sessions. Markets watch this rotation because it hints at where investors are comfortable holding cyclical risk versus where they lean toward defensives and real assets. The question it raises is whether participants see inflation and policy risk as central enough to favor real assets and duration over growth exposure. In our framework's reading of comparable periods, this roughly coincided with broad indexes making limited net progress while defensive sectors and real assets more frequently preserved real value over the ensuing observation windows. An observation under our methodology, not a forecast. A challenge to that pattern would be a clear, sustained rebid into growth sectors that flips their momentum back to green. The conditional map tracks two explicit if-then triggers. If the 10-year Treasury yield crosses 4.45% and holds for 5 consecutive sessions. In our framework's reading, acceleration in the inflation composite appeared in roughly 9 of 11 comparable conditions, a historical characterization, not a forecast. Within a mild stagflation backdrop, that kind of move has historically lined up with the acceleration-style transitions the regime statistics describe, purely as past pattern. If the Fear and Greed Index drops below 15 and holds for 5 consecutive sessions, in our framework's reading, deterioration in the regime confirmation metrics appeared in roughly 7 of 9 comparable conditions, a historical characterization, not a forecast. In the context of the current mid-teens confirmation score and a fear reading in the 30s, that type of shift has historically coincided with less stable regime alignment in our math. The map is live. These conditions are being monitored daily across all 21 series. Atlas is the automated rules-based engine inside Given Analytics. It does 2 things in parallel. First, it publishes a view of the macro environment, the regime, the confirmation score, and the historical base rates we just covered. Second, Atlas runs a fixed 4-layer mathematical framework: price structure, rate of change, risk regime, and market participation across 407 liquid symbols every trading day. When all 4 layers agree on a symbol, Atlas records it as an upside-aligned or downside-aligned condition under the framework, a reading of how the 4 layers line up, not a trade. These are time-stamped model readings, logged for members to study. The environment view and the condition log sit side by side inside Atlas. They are separate outputs. The regime does not pick the symbols, the 4 layers do. Members use Atlas to study how the framework has recorded conditions across prior environments, as historical behavior, not as trade selection. Atlas runs the framework. You study the outputs and environment. You decide what to do next. May, potential, educational are the posture. Atlas is built for context, not instruction. The morning brief is the public surface. The live Atlas dashboard shows the full 21 series regime map, today's mathematical conditions across 407 symbols, and the historical archive side by side. Members study the environment and the Atlas outputs each morning. If you want to track this alongside us, the live view is at givenanalytics.com.